This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, One Rental at a Time, back with his Monday guest and expert, Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. Thanks so much for having me. This is always a privilege.
Oh, I have so much
words
fun.
out of my mouth today.
That's all right. I have so much fun. I get a kick out of speaking with you every week. Thank you so much. It is May 16th, and we are already talking about tax loss harvesting. That's usually a December discussion. That just tells you how bad the year's been so far.
Yep. It's been everywhere. Stocks, bonds, everything in between.
Yeah. So if people don't know what it is, it's a way, well, I'll let you explain it. Cause again, it's something that typically we would talk about in December. But you know what?
Yeah.
We need to talk about it today.
Yeah. Cause what could happen between now and then is, now, I don't know that this is our base case, either one of you, if people have been listening, you could get a run up in asset prices and then you miss out on this opportunity to tax loss harvest. Sure. But basically what this process is, and this is what all sophisticated investors do, is when you get a big meltdown in the market, if you have stuff inside your portfolio in a taxable account that maybe was bought 5-6 months ago and you're down 20% on it. So I'll give you an example. Like say you bought Home Depot, just total hypothetical here.
Yeah.
Home Depot at the beginning of the year, and you're down 19%, whatever it might be. The way tax loss harvesting works is you sell that Home Depot. This is again hypothetical, but you can sell your Home Depot exposure, book that $1,000 loss or whatever it is, and you could immediately buy, if you wanted to maintain that exposure, Lowe's, and know that you're going to get a relatively similar return pattern out of those. They're not going to be apples to apples. I totally get that. But if you really like Lowe's more than Home Depot, or Home Depot more than Lowe's, 31 days later, the wash sale goes away. Exactly. You can sell that Lowe's exposure and buy back into Home Depot. And therefore, you've already booked that embedded loss that you've experienced. And that can be written off against either past gains that you've had this year that you've taken or future gains moving forward and save you 15 to 20% capital gain tax, whatever respective camp that you're in.
Yeah. So tax loss harvesting is an advanced strategy. It's just something that has some basic rules. I want to go through them using your example as I understand them, so people don't get got. If I say something wrong, please correct me.
I will.
First and foremost, the thing you cannot do, let's just say you bought Home Depot at 100, you sell it at 90, you lost $10. You can't buy Home Depot the same day as tomorrow, that week. There's a wash rule, which is 31 days.
31 days, correct. So if you were to sell Home Depot and buy it back 2 days later, this process does not work whatsoever. You maintain the same cost basis you had before.
Yeah. Hence your point about find a company that is not Home Depot, but similar, that you go hold on to for that duration, right? Some people are going to say
probably,
go ahead.
Probably, let me interject there. Probably even better is to look to, so if it's Home Depot, instead of looking at Lowe's, look at a similar ETF.
Maybe, yeah. That might be a way.
A consumer discretion ETF or something like that to give you broad-based exposure. Again, you're going to have individual company risk with Lowe's that you wouldn't have inside the ETF. So you could buy the ETF and you could still, again, sell it back in 31 days if you really wanted that Home Depot exposure.
Yeah, the whole idea here in this rule is selling the thing that you had the loss in, getting something that is similar, either an ETF or a peer or whatnot, for the 31 days. And then if you want, sell out of that one and then get back into your preferred choice. That's kind of the
correct. You're essentially trying to maintain as similar exposure as you can.
Yeah.
And book a tax loss along the way.
Yeah, because
this doesn't just work for individual companies. This also works for, say you have a S&P 500, SPY, and you want to sell out of it and buy a different ETF that tracks the S&P 500. So caveat, there is one little bit of opaque ruling from the IRS. They say you can't buy quote unquote substantially similar holdings. And so that has never been defined. So they intentionally leave it that way. I've seen it defined not by the IRS, but by an individual tax attorney as something that has 0.99 or higher correlation, meaning essentially it is the exact same thing. But at the end of the day, I'll say this, and you could take this any which way you want to take it, but I would say this is how I look at it. The IRS has to audit you, and the IRS has to prove that that is substantially similar with a 99% correlation in order for them to want. And again, it's not like you're doing something illegal here. You would just have to pay the taxes that you were already due to pay anyway.
Yeah, or you wouldn't get the loss that you had tried to recognize.
You wouldn't get the loss. That's better put. That's exactly right. Yeah. So at the end of the day, I don't know that there's any real risk in doing that.
Yeah, the whole idea of this rule, again, these are what the sophisticated investors do, right? Sometimes you make a bad choice, but in this case, the whole story here is you want to keep Home Depot. That's the whole story. You want to keep it.
Correct.
Instead of sitting on your $10 loss in my example, you sell it, you book the $10 loss, you find some other entity similar, so you still have like correlation. 31 days go by, the wash rule is bumped, sell that, buy Home Depot back, your cost basis is lower, and you have a loss.
Correct. It's a win-win. Exactly right. So you have that cost basis move down and you have that loss that you will write against a gain in the future. This is, to Michael's point, this is what every big portfolio manager of a mutual fund has to do. Now, mutual funds have to worry about those embedded gains. ETFs do not. So we don't need to get into that story because that's another rabbit hole. But nonetheless, every big mutual fund portfolio manager that runs billions of dollars in their portfolios, if they have something that unravels on them in the short term because the economy is doing what it's doing, they do this every single time. It's foolish not to do it.
Oh, absolutely. And again, folks, this is why this normal conversation will come out in December, because the average or retail investor doesn't think like this. We have an opportunity now. Look at your portfolio. Are there things that you kind of like long term, but you would like to book a loss? You know, these are what the big boys do.
To state the obvious, don't think about this inside of a qualified account, a 401k, a 430, a 403b, a 457, an IRA. That, you know, taxes are not an issue there. You don't have to pay tax on your gains there. But this is for, again, that brokerage account, that after-tax money that's out there, and you're worried about taxes.
Exactly. Folks, if you want to get great advice to this and have someone to follow, go to Life Goal Investments on Instagram. Daily content. Great to watch. You guys are doing some great stuff there, Taylor.
You're the man. Thanks for the kind words, Michael.
All right, buddy. Take care. Have a great week. All right.
You too. Thank you.
Mm-hmm.